indices. But let's move on then and hear it out from an exclusive interaction with Alchemy Capital CEO and Director and CIO Hiren Ved. He says that financials are not that expensive at this point, and his view on tech is that it could bottom out by Q1 or Q2 next year. Let's hear him out.
I clearly feel that we are at the fag end of the tightening cycle. So there may be a little more pain, little more uncertainty going into it, but I think bahut gayi aur thodi rahi as far as interest rates and inflation is concerned. I think what is more important is that, India has behaved in 2022 like a strong stock. Right? If India was one stock, it has behaved like a strong stock. It outperformed global markets. It didn't fall much when global markets were falling. And at the slightest sign of stability, the markets would kind of go up. Will India continue to remain a strong stock? I think yes. Right? Now, whether some other markets, because of a very low base, may outperform India next year. Like a lot of people are hypothesizing that China may do better because China has fallen so dramatically, right? That may happen. But I think India's structural growth story post-COVID has never been as strong as we are witnessing today. So I think my bet, more than trying to predict what the returns are going to be, I think, as they say in markets, stay with strength, get out of weakness. I think I would stay with the Indian markets because clearly it is exhibiting strength.
2023, could it be a year of positive returns?
I would think so. I mean, at least I would bet on that it will be a year of positive returns. And my reasoning is fairly simple, right? If our hypothesis that interest rates will peak out are right, then I think that India should be able to deliver double-digit returns in terms of double-digit earnings growth, at least for the next 2 years, which may not happen in 22-23. Clearly because we saw that there was a negative operating leverage in terms of EBITDA margins. In the first half of the year, we've seen the numbers. There was almost a 500 basis point knock off on EBITDA margins. And the EBITDA margins of non-financial companies is back to pre-COVID levels. So all the benefit of higher EBITDA margins that we got during COVID, we are now back to that. Largely that hit has been because of higher commodity prices, right, and supply chain problems and higher energy costs. I'm hoping that some of that hit in the margins will come back in the second half of this year and also next year. So you will still end up at 13-14% earnings growth for the next 2 years, which means that for FY25, if your Nifty EPS is somewhere in the region of 1050, 1070, I think we should be able to eke out a double-digit returns in 2023 on the Nifty.
Okay, so the earnings growth largely will come in cyclicals. It will come in banks, stroke financials, little bit of consumer. But for a lot of these sectors, valuations are already at the high end of the spectrum, which means for the performing sectors now to go higher in stock market returns, even the earnings will grow. From these levels, the valuations could really cap that 10-15% upside also.
So Nikunj, I think I agree with you that there are certain sectors where valuations are reasonably high, and some of those growth sectors where people have started, we even discounted FY24 and 25 numbers, right? So there could be a case that there could be a valuation upside. I mean, in a valuation cap in terms of there is no place for P multiples to expand. In fact, they may contract a little bit. And there I think it's really what earnings growth these companies are able to deliver, right? Banks are not yet that expensive, so I think there is still room to run.
Give me a benchmark. Why do you say that?
So I think, I mean, obviously the best of the banking rally in my view will happen in another 1 or 2 quarters, right? Because you still have space for margins to remain at elevated levels. But come Q1 next year, I think margins should normalize, because what happens is that your asset side gets repriced faster than your liability side. And you have very little credit costs, and credit growth is very, very strong, right? But that will normalize next year, right? So you still have 1 or 2 quarters of very good growth in financials, and financials may continue to compound, but that massive outperformance that we've seen should kind of by the middle of next year or maybe early next year should kind of get all priced in, because everybody knows the story, right, broadly. I think you will have to go really bottoms up to eke out returns in 2023, because what happens is that any sector where there is the narrative is very strong, everything gets priced in very quickly. So you really have to go hard and find companies which will make money for you, right? I think tech could bottom out in somewhere between the first and second quarter next year. What I mean is calendar quarter, because I think all the bad news about slowdown and the US recession and blah 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 should get priced in. People will wait for the guidance and so on and so forth, but I think we should see a bottoming out in tech somewhere in Q1, Q2 of next year.
So 2023 could be a mirror image of 2022. When we started 2022, tech was top of the pedestal, banks were the bottom of the pedestal. When we are wrapping out of 2022, banks are up and IT is down.
Yes.
Somewhere in 2023, the reverse could again happen.
Yeah, I mean, I think that clearly, I think that you could have a first half continuing to be good for banks, and then the second half continuing to be very good for tech again, right? So that is quite possible that can happen. But I think that, you know, the big manufacturing theme that we've been talking about is something which could be a multi-year theme in India. We almost had a lost decade of manufacturing between 2012 or 2011 and 2020, you know, when the first scams broke out, the telecom and the coal and the mining, and then the whole industrial environment became pretty muddled. And after that we had Demon and GST and IL&FS, and you know, so we really lost those 10 years. Now we are seeing some resurgence in manufacturing. In fact, the RBI, you know, as you would have read today, has said that they are seeing some light of the day. And the reason why on a slightly medium to longer term we are bullish on manufacturing is because there are 2 sectors in the world which are going through a massive transition. One is energy, where everybody is moving from traditional energy to new energy. And also because of the current challenges, there is a lot of pressure to mine more coal, and you know, which is what is happening in the West, right? But if you take a slightly longer term view, everybody in the world will have to spend more on renewable energy. It's very clear. 2 of your biggest business groups in this country have a very ambitious plan on energy. The second industry which will have to completely transition is automotive or transportation, right, where you will move from traditional fuels to electric vehicle. And it's a global capex cycle, it's not just in India. Then specific to India, you have 2 other sectors where there is a big opportunity. One is in electronic manufacturing, where more is going to be made in India. And there again, two large business groups have even talked about setting up semiconductor manufacturing in this country. And the fourth one is defense, where there is greater demand for getting stuff manufactured in India, right? So you have energy, you have transportation, you have defense, and you have electronics. Where in the past have you had four large sectors all contributing, and then you can add railways and a lot of other stuff, right?
So let's start discussing all the sectors one by one. Energy transition, whether it is solar or whether it is gas. Ultimately, we are going towards the cleaner source. We are looking at more energy, sufficiency after the so-called Ukraine and the entire Russian war. For an investor who says, okay, I like what Hiren is saying, it's a big picture theme, next multi-year, multi-billion capex and multi-year cycle. What is the best way to bet on it? And aren't markets already factoring in what you are indicating?
No, because there are far fewer plays that you can do in renewable energy today, right? The direct opportunity set is not very big. You could play it through, let's say, a company like Reliance, right? Because they are attacking the entire value chain. That's one way to do it. But there are a lot of other companies in the ecosystem which will benefit out of that, right? Maybe a typical auto ancillary may supply into renewable energy, right? Bharat Forge, for example, right? I mean, they could supply to the oil and gas industry, but they could also supply castings and forgings, for windmills, for example, right? So you may have to find indirect plays which will benefit from the capex spending in renewable energy.
What are your indirect plays in energy?
I think there are quite a few engineering companies, there are turbine companies, and then there is somebody like a Reliance which you can look at if you want to play the entire value chain.
Okay.
Right?
Now EV, another transition.
Yes.
Global capex cycle is on, whether it's ancillary, whether it is real capex in batteries and other, in EV related assembly lines.
Yeah.
How are you betting on this theme? Are you looking at direct plays, indirect plays?
Again, I mean, you could play it through some OEMs,
Okay.
right, which have taken a lead in EV. But a better way to play that is to play into component suppliers into the EV theme. And we've done that early by betting on some of the ER&D software companies.
Like Tata Elxsi will qualify.
Elxsi, KPIT are classic two examples of companies that benefit from this whole electric vehicle revolution around the world, because they are not limited to India. They are supplying software and technology to all the OEMs around the world, right? So the globe is their market, and this is a global opportunity. It's not just an India opportunity. So you want to play an India opportunity, you buy an auto ancillary or a battery company. You want to play a global EV opportunity, you buy a software company, because for them the customers are global, right? In each of these, especially these two, right, I think because it's a very long-term trend, you will find more companies much later over the next couple of years where you will be able to bet on some of these companies directly. But right now the most efficient way to play this theme is to do it indirectly, and you will find companies. It's like a picks and shovels approach, right? You don't want to buy the diamond company, but you want to buy the guy who's mining the diamond. And I think you have to do the same thing when it comes to these two themes.
Okay. Large part of the time what we've had last year was consumer and understanding fintech or consumer tech. It's almost been like a boom and a bust cycle for some of them. Could 2023 be the year of revival for them?
I think so. They have gone from being darlings, and we've had a very euphoric IPO debut for many of these companies, and now they are the ugly ducklings of the market. Everybody wants to kick them, right? And partly rightly so, because the valuations were very exorbitant. And also the macro backdrop has changed. There is no more free money available. And therefore profitability and cash flows, which has always been important, are even more important now. And therefore you will find that each of these companies have started giving you a guidance of when these companies will start becoming profitable, right? I think the only, so I think it will be quite interesting that we will in 2023 sometime be able to pick some of these companies, because they've built real businesses. It's not that they've not built real businesses. But there were two problems. One was that obviously capital allocation was very liberal, right? You were trying to do everything because money was available to you, very easily. So you kept spending, kept experimenting. Now companies are focusing and saying, okay, I need to be profitable, I need to generate cash flow. So you have to look for whether there is capital allocation discipline. The other problem really is the supply, right? I mean, like, everybody is trying to rush out of the door. The PE investor, the first round investor, the last round investor, the founder, sometimes you never know. I mean, there is just a surfeit of supply of stock. So traditionally, we have always looked for companies where you say that these companies won't raise too much equity and therefore they won't keep coming to the markets to keep diluting their equity, but that's not the case, right? So I think we have to sort out some of those things, and maybe this excessive supply will give you a better entry opportunity in some of these companies. But I think it's definitely a place to look for, because I don't think now there is anybody funding the next food delivery guy. I don't think anybody is funding the next fintech guy.
I'm not getting my milkshake for free now.
Exactly, right? So I think whoever survives and whoever gets to profitability and builds a solid business there will be value creation that will happen. But again, as I said, we have to negotiate this massive supply which keeps coming in these companies.
Which one is your favorite? I mean, the four names which come to our mind are Paytm, Zomato, Policybazaar and Nykaa. These are the four ones which in a sense have been the most talked about IPOs. Do you own Zomato, which is what I remember?
Yes,
but
we do.
Have you added more Zomato?
So we own Zomato in some of our offshore portfolios directly, but in our domestic portfolios we own it via InfoEdge, right? So we own both Policybazaar and Zomato via InfoEdge. We thought that was a cleaner way to play, because you have the cash flows of Naukri, but you have the upside of some of these companies which are, there is some valuation which you can build for these businesses as they bottom out from here and start growing, right? So I think we will look at all the 4 or 5 which are there, and there will be a great opportunity to get into some of these.
So the timing right now, the current decline is not the great opportunity. You think that they can fall a bit more?
Yeah, I think it's going to be difficult to exactly time the bottom, right? But I think sometime during 2023 would be a great time. You will get a great entry point in some of these businesses. And it's okay, I don't want to be the guy who buys at the bottom. It's better to have conviction on the path towards profitability and then buy a little bit higher. That's fine, because the runway for growth is many, many years. It's not going to, go away tomorrow.
Any other IPO which comes to your attention, while, like I said, that we've spent a lot of time in analyzing and over-analyzing and sometimes over-discussing these 4 or 5 fintech companies because they have been the poster boys, but there has been a raft of IPOs from the manufacturing space, from the microfinance space. FMCG companies like BKG have gone public. Anything else which caught your attention in terms of a new debut, a small company or a medium-sized company which potentially could be big in next 3 years?
So again, we've been very, very selective in trying to capture opportunities in IPOs, right? My view is that the best time to invest in IPOs when the markets are in shambles, because that is the time when you probably get better valuations. I don't think that was the case, right? So we've been very, very selective, and we haven't actually participated in great many IPOs at all in 2022. I think the only one which we did in the recent past was Ethos, which we thought was very interesting because the whole luxury retailing space in India is just about very nascent and growing, and they've done a phenomenal fine job, right? So we used to own the parent company called KDDL, which is into manufacturing, and then the sub got listed, which is Ethos, which is into luxury retailing. I think they are in a sweet spot. The next few years they can compound at 20% plus for the next couple of years. So we found that interesting because we had a long history of knowing that company for a long period of time. But I think in most of the other cases we would kind of wait and watch, let a couple of quarters go by, get to understand these companies better, and then look at investing in them. Because the history of IPOs has not been so good, right? I mean, you get a great flash in the initial few quarters, and then very few of them have been able to sustain that valuation. So the real price discovery happens after the first 2-3 quarters, and markets will always give you a chance. So for us, IPOs is a good time to keep researching and following these companies, not necessarily diving into them.